Understand this for your Forex trading success. It is common knowledge in financial markets that both traders and investors spend a lot of time predicting the future by studying past market behavior. The method used is historical data analysis, which in practice turns out to require fundamental and technical perspectives so that traders and investors can position themselves and anticipate future opportunities as well as learn about past weaknesses. Just a reminder, fundamental analysis is generally used to observe various strategic aspects such as government policies, the central bank, and regular economic data that can be used as a reference in predicting the direction of market movements. Meanwhile, technical analysis is usually implemented to read the expectations and possible actions of market participants through direct observation on the price chart. Historical data analysis. This approach actually focuses on paying attention to the market in a chosen time frame. Much can be explored there, starting from the price of the asset or security itself, the level of volatility that surrounds it, as well as changes in the volume of transactions. Each discussion is peeled and quantified so that what happened in the past can be concluded, reinforced with context, and become an inseparable part of trading or investment plans now and in the future. So it can be understood that historical data analysis offers many benefits, including enriching the insights of market participants, supporting innovation in trading and investment systems, and increasing the confidence of traders and investors in their efforts to achieve consistent and sustainable profits. Three basic principles of historical data analysis. There are at least three basic principles in historical data analysis, which are also widely used in technical approaches, namely: 1. Market discounts everything. This is one of the classic rules in Dow theory that has been around for more than a century and means that asset prices reflect all information circulating in the market, whether related to the past, present, or future. In Forex, this principle can be interpreted that what is currently happening in a currency pair is a reaction or correction to a larger time frame. 2. Prices move in trends. This means that the price moves in a path, be it up, down, or flat, until the surrounding trend ends. By understanding the trend, traders and investors have a reference to where the market is going and continue to position themselves in that direction. 3. History tends to repeat itself. This means that the historical price of the asset is likely to repeat itself in the future. Such a situation is understandable considering that market participants tend to react the same way to similar events. Maybe not completely repeated, but at least it can be used as a reference in making trading decisions. Summary. In this regard, looking at the time frame is highly recommended to find a picture of opportunities in the past. The longer the selected time span, the more visible the historical pattern trend is. In addition, a backward review of the support and resistance side will also be very helpful. Thank you for watching. If this is useful, please support this channel so that it can grow by clicking subscribe and like. If you have any questions, please ask in the comments. You can also check other videos about Forex.